What are mutual funds and who are they for? Hey everyone, and welcome back to X100%, the channel where we break down complex financial topics and make them, 100% clearer. I'm your host, Eddie, and today we're diving deep into the world of mutual funds. I know, mutual funds might not sound like the most exciting topic at a party. But trust me, understanding these incredibly versatile investment tools can be a major turning point in your financial journey. They're like the Swiss Army knife of investing, useful in so many situations. Let's start with that story I mentioned before, but let's add some more layers. Imagine you're not just a good sourdough baker, you're a legendary sourdough baker. People line up around the block for your bread. You've got this incredible secret family recipe, passed down for generations. But your dream is bigger. You envision a grand, European-style bakery, a place where the aroma of freshly baked bread mingles with the scent of rich chocolate and delicate pastries. You could try to do it all yourself. You could spend years, maybe even decades, mastering the art of the perfect croissant, the science of a flawless soufflé, the intricacies of sugar sculpting. You'd need to buy specialized ovens, mixers, proofing cabinets. The list goes on and on. The financial investment alone would be enormous, not to mention the time and the risk of failure. Or you could collaborate. You could find a pastry chef who spent years in Paris, learning from the masters. Someone who can create a croissant so light and flaky, it practically floats off the plate. You could partner with a cake decorator whose creations are so stunning, they belong in an art gallery. And a chocolatier who can craft bonbons that are tiny explosions of flavor. Each of these specialists brings their unique skills, their own secret recipes, and their own network of suppliers. By pooling your resources, your sourdough mastery, their specialized expertise, and everyone's financial contributions, you create something far greater than any of you could achieve alone. You build that dream bakery not in decades, but in a fraction of the time. And you share in the profits proportional to your investment. This, my friends, is the core concept of a mutual fund. It's a collaborative investment vehicle. It allows individual investors like you and me to pool our money together and invest in a diversified portfolio of assets that would be difficult, if not impossible, to assemble on our own. It's about leveraging the power of collective investment. Think about it. To build a truly diversified portfolio, you'd need to buy shares in dozens, maybe even hundreds of different companies. You'd need to research each company, analyze their financial statements, understand their industry, and monitor their performance. And that's just stocks. You might also want to invest in bonds, real estate, commodities, the list goes on. It's a full-time job. That's where the fund manager comes in. This is the experienced professional, the head chef of our investment bakery, who does all that heavy lifting. They have a team of analysts who spend their days researching companies, analyzing market trends, and identifying investment opportunities. They have access to sophisticated tools and data that most individual investors don't. Let's dig into those key terms a bit more. When you invest in a mutual fund, you're not buying individual stocks or bonds directly. You're buying shares of the fund itself. The price of each share is called the net asset value, or NAV. This NAV is calculated at the end of each trading day, and it represents the total value of all the fund's assets, minus its liabilities, divided by the number of outstanding shares. So, if the fund owns shares in Apple, Microsoft, and Amazon, and those stocks go up in value, the fund's NAV will also go up. If those stocks go down, the NAV will go down. It's a direct reflection of the performance of the underlying investments. Now, let's talk about the different flavors of mutual funds. Just like our bakery can specialize in different types of pastries, mutual funds specialize in different types of investments. And there are thousands of them. But here are some of the most common categories. 1. Stock funds, equity funds. These are the workhorses of the mutual fund world. They primarily invest in stocks, also known as equities. But even within stock funds, there's a huge variety. 1.1 Large cap funds. Invest in large, well-established companies. Think Apple, Google, Johnson & Johnson. 1.2 Mid-cap funds. Invest in medium-sized companies, often with higher growth potential than large caps, but also more risk. 1.3 Small cap funds. Invest in small companies, which can be the most volatile, but also offer the highest potential returns. 1.4 Growth funds. Focus on companies that are expected to grow their earnings at a faster than average rate. 1.5 Value funds. Focus on companies that are considered undervalued by the market. 1.6 International funds. Invest in companies outside the U.S. 1.7 Emerging markets funds. Invest in companies in developing countries, which can offer high growth potential but also carry significant risk. 2. Bond funds, fixed income funds. These are generally considered less risky than stock funds. They invest in bonds, which are essentially IOUs issued by governments or corporations. When you buy a bond, you're lending money to the issuer, and they promise to pay you back with interest. 2.1 Government bond funds. Invest in bonds issued by the U.S. government, considered very low risk. 2.2 Corporate bond funds. Invest in bonds issued by corporations, which carry more risk than government bonds but also offer higher potential returns. 2.3 High-yield bond funds. Junk bonds invest in bonds issued by companies with lower credit ratings, which offer the highest potential returns but also carry the highest risk. 3. Balanced funds. Hybrid funds. These funds aim for a Goldilocks approach. Not too hot, not too cold. They invest in a mix of stocks and bonds, seeking to provide a balance between growth and stability. The specific mix of stocks and bonds will vary depending on the fund's objective. 4. Index funds. These are the passive investors of the mutual fund world. Instead of trying to beat the market, they simply try to match it. They do this by tracking a specific market index, like the S&P 500, which represents the 500 largest U.S. companies. Because they're passively managed, index funds typically have lower fees than actively managed funds. 5. Target date funds. These are designed for long-term goals like retirement. They start with a more aggressive asset allocation, more stocks, when you're young, and gradually shift to a more conservative allocation, more bonds. As you get closer to your target retirement date, it's like having an autopilot for your retirement savings. 6. Sector funds. Invest in a specific industry. For example, a technology sector fund will be invested in tech companies. So, who are mutual funds really for? They're incredibly versatile, making them suitable for a wide range of investors. But they're particularly well suited for 1. Beginner investors. Mutual funds provide instant diversification, even with a small initial investment. You can start with as little as $50 or $100 in some cases. 2. Time-crunched investors. If you don't have the time or inclination to research individual stocks and bonds, mutual funds offer a convenient way to delegate that responsibility to a professional. 3. Risk-averse investors. While all investments carry some risk, mutual funds offer diversification which can help to mitigate that risk. And there are many different types of mutual funds to choose from, ranging from very conservative to very aggressive. 4. Goal-oriented investors. Whether you're saving for retirement, a down payment on a house, your child's education, or any other long-term goal, there's likely a mutual fund that aligns with your objectives and time horizon. 5. Investors who prefer professional management. Some investors simply prefer to have a professional money manager making the investment decisions. But let's be clear, mutual funds aren't perfect. There are downsides to consider, just like any investment. It's like our bakery. Even with the best chefs and the finest ingredients, there's always the risk of a batch of croissants going wrong, or a sudden drop in customer demand. Here are some of the key drawbacks of mutual funds. 1. Fees and expenses. Mutual funds charge fees to cover their operating costs, including the fund manager's salary, research expenses, and administrative costs. These fees are typically expressed as an expense ratio, which is a percentage of your investment. Even a small expense ratio can eat into your returns over time, especially in a low-return environment. It's like the cost of running our bakery, rent, utilities, salaries. These all reduce the overall profit. 2. Lack of control. When you invest in a mutual fund, you're giving up control over the specific investment decisions. You're trusting the fund manager to make the right choices on your behalf. This can be a good thing if you don't have the time or expertise to manage your own investments, but it can also be frustrating if you disagree with the fund manager's strategy. It's like letting the head chef decide the menu. You might not always agree with their choices. 3. Potential for underperformance. Not all fund managers are created equal. Some consistently outperform the market, while others consistently underperform. And past performance is no guarantee of future results. A fund that performed well last year might perform poorly this year. It's like our pastry chef having an off day. Even the best can make mistakes. 4. Tax inefficiency. In some cases, mutual funds are required to distribute their capital gains, profits from selling investments, to shareholders each year. These distributions are taxable, even if you reinvest them in the fund. This can be less tax efficient than holding individual stocks or bonds, where you only pay taxes when you sell them. It's like having to pay taxes on the bakery's profits every year, even if you reinvest those profits back into the business. 5. Over-diversification. It is possible for some funds to become too big. When this happens, they may have to invest in so many different companies that it's hard to generate significant returns. So, how do you choose the right mutual fund? It's not about finding the best fund, because there's no such thing. It's about finding the fund that's the best fit for you. Here are some key factors to consider. 1. Your investment goals. What are you saving for? Retirement? A down payment on a house? Your child's education? Your goals will determine your time horizon and your risk tolerance. 2. Your time horizon. How long do you plan to invest? If you have a long time horizon, e.g. 20+ years, you can afford to take on more risk. If you have a short time horizon, e.g. less than 5 years, you should be more conservative. 3. Your risk tolerance. How comfortable are you with the possibility of losing money? If you're very risk-averse, you should stick to more conservative funds like bond funds or balanced funds. If you're more comfortable with risk, you might consider stock funds or even sector funds. 4. The fund's investment objective. What is the fund trying to achieve? Is it focused on growth, income, or a combination of both? Make sure the fund's objective aligns with your own goals. 5. The fund's expense ratio. How much does the fund charge in fees? Look for funds with low expense ratios, especially if you're investing for the long term. 6. The fund manager's track record. How has the fund manager performed in the past? While past performance is no guarantee of future results, it can be a useful indicator of the manager's skill. 7. The fund's holdings. Review what the fund actually invests in. Okay, let's do that comprehensive recap. We've covered a lot of ground today. What are the key takeaways? Mutual funds are like a team of investors pooling their money together, much like a team of specialized bakers creating a diverse bakery. A professional fund manager acts as the head chef, making the investment decisions and managing the portfolio. There are many different types of mutual funds, each with its own investment objective, risk level, and strategy, like different types of pastries in our bakery. Mutual funds offer instant diversification, professional management, and convenience, making them a great option for beginners and those who don't have the time or expertise to manage their own investments. However, mutual funds also have downsides, including fees, lack of control, and the potential for underperformance. Choosing the right mutual fund requires careful consideration of your investment goals, time horizon, risk tolerance, and the fund's characteristics. Mutual funds are a tool, and like any tool, they can be used effectively or ineffectively. The key is to understand how they work and how they fit into your overall financial plan. And that's a wrap on our deep dive into the world of mutual funds. I hope this extended, story-driven explanation has demystified these powerful investment vehicles and given you the confidence to explore them further. Remember, investing is a marathon, not a sprint. Take your time, do your research, and don't be afraid to seek professional advice if you need it. If you found this episode helpful, please smash that like button, subscribe to X100% for more financial clarity, and share this with anyone who might benefit. Until next time, this is Eddie signing off. Keep learning, keep growing, and keep striving for that 100% financial success.